We have our last panel of lawyers, and I'm a lawyer and I wanted to share something a client shared recently I thought you guys might find somewhat funny. So we had a 12-year-old who is a client's son who looked at some of the documents we prepared for them. The question was, Dad, why are lawyers so boring? And I thought it was funny, and I just wanted to share both from a lawyer perspective and from a client perspective where some of the fun is. I started off as an engineer, and these lofty thoughts of you want to change the world with some technology. And when I became a lawyer, I realized you get to be a part of everybody's story and everybody trying to change the world with their technology, and that ends up being quite a bit of fun. And from the perspective of the entrepreneurs, management, people that come in as clients, we're the ones that worry about the stuff that you guys don't want to have to worry about. You hear about people get in trouble with ICOs, with the SEC, and we're here where you don't have to worry about that, where we think about all these issues. And usually we give you this high-level guidance, and these kinds of panels are really interesting because you get to see at a high level what's the stuff you have to worry about. And then we go do the real worrying for you so that you can concentrate on the stuff that matters to you, of growing your business, raising your money, whatever it is that's your dream to accomplish. So with that, let me hand it to the panel.
Thank you. All right, so this has been a fun afternoon. My name is Amanda Salvioni. I work with Radix Law in Scottsdale. I basically represent people in commercial real estate and a lot of entrepreneurs, small, mid-sized businesses in all sorts of capital raise activities. It's been very entertaining sitting here and listening to everything today. Jor Law and I are going to just more chat about some of the things that had come up earlier and just ask questions, and if anyone wants to chime in with any questions, please feel free. Just as like a general observation, I think it's interesting all of this talk about, whether we're calling an investor stupid if they don't qualify as non-accredited, and basically by saying they can't participate in certain ICOs, that makes them dumb and things like that. I don't really think that's exactly what the point is supposed to be of it. And, if one discussion is, hey, let's change the definition of accredited investor, that might be a little different. But, if I want to go gamble, I can walk into a casino and lose $10,000. But when I walk into the casino, the difference is I know basically walking in, the house pretty much always wins. When I'm playing in some of these ICOs, I'm thinking I actually might have a chance of winning something. And there's not all these disclaimers and things readily apparent oftentimes saying, hey, you have a very good chance of potentially losing this all. So when we're talking about disclosures and the need to make disclosures so investors can make informed decisions, it's to help promote, like what Keith was saying earlier, help promote the capital markets and things like that, avoid these pump and dump schemes, these short sale techniques, these techniques that overinflate value in certain tokens to the detriment of people who may not have all day long to sit there and watch, or may not have a bot tracking these things and things like that. But just to back up a second, I just was curious. So what's a security? Let's just make it very basic.
Yeah, I think just for the most basic thing is, if you're raising money and, someone's giving you money and that's tied to some sort of, hopeful increase or, value or getting something back, and they're not the ones working for that, just assume that it's a security. That's not generally how you hear it defined at these conferences, but in general, it's a security when you're raising money and really it's an investment. Right, and that's common sense. A lot of people get into the weeds of like, oh, well, technically, what is it? But like in this space, everyone tries to play this game of like, well, we're a utility token, we're not investment or a security token. Look, if it feels like a security, if it feels like an investment, it probably is a security. And that's how the SEC is looking at it now. No question, the laws have to get adapted or changed or interpreted a different way. But today, the SEC is basically looking at these things and they're saying like, look, we're not stupid. Like, if it looks and feels like an investment, it probably is a security. And that's why they're saying that almost all ICOs are securities. Like, are they really? Like, obviously you can think of a pure utility token. You could think of a pure utility token even being offered. But the way ICOs have been offered, pretty much they've all been offered as investments, and that's what is concerning to regulators around the world.
Well, and so a lot of times lately it's, hearing people using these SAFT agreements or trying to do things to avoid being seen as a security without having to answer a difference of what a utility token versus security is. Sorry. And like Jor was saying, I don't think it necessarily matters that much if it's a utility versus security token, because, Jay Clayton even this year has said it's not necessarily the token itself. If there's some reliance that I'm putting money into something and it's gonna, I can rely on you and your efforts to go turn my money into more, or allow me to all of a sudden buy way more ad space with the same dollar I could have only bought one ad space with originally. I'm relying on you to get your butt out there, hustle this business, make it grow so that my token's worth more and I can do more with it. But even all of that aside, I think really the bigger issue is this secondary market issue. Like, what do you do after? So if you have these securities that aren't registered and you sell them to people, then what happens after that?
The secondary market issue is pretty bad. Not because they're that difficult for like one country. It's actually not that hard. If you only had to look at like one country's laws, and you look at their issuances and you look at their resale laws, it actually isn't that bad. Where it gets really difficult is when you're trying to consider every country's laws and every type of security, and the fact that some things might be securities, some things may not be securities in one country versus another country, and then the interchangeable ability and tradability between people of that security, right? That's where things get difficult. This is honestly something that people are still thinking about it. I have a company that is owned by T0, which is one of the players in exchange and secondary liquidity markets. So this is something that they're looking at every day. This is something that they're consulting, lawyers and lawyers like us are thinking about every day. There's no great answer to it right now, mainly because if you locked everything to a very closed, ecosystem, for example, if I only cared about liquidity within the U.S. For U.S. securities tokens, so to U.S. people only, that's actually very easy to figure out. It's when you try to add everything else, it becomes a little bit harder. And honestly, I think it's going to be a while before someone figures it out, or countries come together and they start saying, well, if someone's traded on your exchange per these criteria, then we're going to recognize them under law, on our exchanges.
Because
Can you please just explain this issue more? Let's say it's very simple. We are just talking about the US. How would they trade?
Well, part of the issue here is when if we're doing an ICO, let's just understand that you could do an ICO as an IPO, a Reg A plus, a CF, a Reg D. You're still fitting into one of the other frameworks, leaving aside the fact that I get that there are mechanical things that are different in this than, other securities. But you can make 2,500 new things, and the definition of a security is so broad that they're most likely going to be a security. So when you're using Form D as an exemption, Regulation D as an exemption from having to register, and then on top of it, you want to use 506C and be able to generally solicit people, which you can do if you're getting accredited investors and verifying that they are accredited. Well, there's restrictions on the ability to transfer. There's a restrictive legend that's supposed to go on the interest that's issued that prevents that person from being able to transfer it from 6 months to a year, depending if the company files certain disclosures. So when you're going and trying, sell these things to people and you're saying, hey, you're going to hold on to it for a little bit and then you're going to be able to have this marketplace where you can go sell it and trade it. It's like, okay, well, if it's actually a security that was covered by an exemption, there's probably going to be some restrictions on transfer.
Yeah, so right now the way security tokens have been, you had this evolution of basically non-compliant tokens, and then you kind of had the first round of people saying, oh, okay, we're securities tokens, we're going to issue them out under some valid securities exemption. And then along with that, you kind of had some people say, oh, well, heck, we have to do AML KYC, right? So that's where we are today. Today, we're at the stage where people are issuing out security tokens purportedly in compliance with some sort of crowdfunding law under the US, and they're doing AML, KYC. The next evolution is going to be restriction transfers built into the tokens, not artificial ones like lockup of 12 months. You see a lot of people that are just doing lockup of 12 months because that's easy, it's lazy, and it's efficient, and that's where the world is today. But you're starting to see a number of companies, Harbor, Black Moon, Polymath, where I'm an advisor, I have to disclose, and a number of these ecosystems are building, and what they're trying to create is something very similar to our ERC20 token, except for its built-in security token standards with restrictions.
Sorry.
So that will come out, I think the first ones will come out in about a month's time, and then over the course of 2018, they'll get better. And honestly, it won't be toward the end of 2018 or 2019 before you have a full set of smart contracts that really can deal with the restrictions in a really automated way.
Do you think more of a technical thing, if you use the SAFT and so you're selling the future token and then later go and issue it, do you think that your original date of ownership will date back to when you sign the SAFT or when the token's issued?
Okay, I have controversial views here. Back when all the law firms were doing SAFs let's go back. Back when all the law firms were doing utility tokens, our law firm was laughed at because, we would consistently tell people like, no, we think these are securities. And everyone would say like, you guys don't know what you're doing. We're going to go hire, said firms that are famous because they tell us that we're not. So fast forward about a year, 12 to 18 months later, some of those firms are under SEC investigation, and we're out a lot of business for giving good advice. But now you've got this other flip thing. Now suddenly you have people that, for a period went out and said, oh, SAFs are great, SAFs are awesome. And then now the SEC's kind of like disfavored SAFs. Not because they really disfavored SAFs, they disfavored how—
Workaround.
They disfavored the workaround and the implication that, well, if you just do a SAF now, it's a security, and if you issue out the token later, it's not a security. Not saying that mentality is necessarily wrong, but I think the SEC basically suggested like that's not necessarily true. Like we do not agree that that is a 100% factually correct statement. But now you have like firms taking a complete 180 where they're like, oh, we don't do SAFs. SAFs are illegal. They're bad. I do not speak for my firm when I say this. Do not speak for all lawyers when I say this. But that's bullshit. Of course, SAFs by themselves have no legal issue. If they did, then every pre-sale agreement would be illegal. If they did, then every simple agreement for future equity would be illegal. SAFs by themselves are, without anything else, I don't think are illegal. Unfortunately, I think the industry's moved there and has suggested that, oh, you shouldn't use SAFs. So everyone's doing the same thing. They're just calling like pre-sale of tokens now instead of using the word SAF, but it's still a damn SAF. I mean, do you agree?
I agree.
Sorry, I'm passionate about this
because
lawyers have gone the wrong way on this.
Well, and it gets frustrating because it's like some of the money is spent with clients trying to convince them that they should maybe not be trying to find a workaround and just comply.
Yeah, he's got—
Probably could have been the same amount of money spent to actually comply.
I heard you use the phrase, automated contract, and from my perspective, what I invented, I can't understand how they can be automated if you can't actually verify the party on the other end is who he says he is, because if you don't have the right party, you don't have the right consideration, and the other party is someplace else in the world. And can you speak to that?
Yeah, so identity is something that you have to think closely about, obviously, anytime you talk about regulation, because regulators always want to know who they're regulating. So people are thinking of solutions here whereby the securities tokens are being sold to people that have AML KYC'd, and they're only going to be allowed to be sold to other people that have been AML KYC'd. So they will actually solve the identity issue. Now, there's various ways to do it now. None of them are fantastically elegant or as automated as someone would want them to be, but essentially you'd have to think of it as person goes through Oracle, gets approved, is now on a whitelist, therefore can take on this action.
And just trading on Coinbase isn't enough to say somebody was accredited.
So, did I understand you correctly when you said that pre-sale of tokens are pretty much the same as SAF?
Essentially, to me, like, what is it, right? Simple agreement for future tokens. I'm giving you this money now, you're giving me tokens in the future. How is that functionally different from the tokens are not yet ready, iPhones are not yet ready, but if you give me money now, when it's ready, I'll give it to you.
We care about substance over form.
Right, it's basically the same thing.
So, do you have any sort of preferred modality for ICOs, whatever we call them?
Not necessarily. I don't think my mission is really saying like, this is the one best way to do it. Certainly, if you wanted to just wait and have a token, you could do it. It's very interesting to see some of these multiple token structures where you get a token that's clearly a security token, and then maybe you get another token that's clearly a utility token, which isn't actually sold, but it's just consumed in the ecosystem. I'm personally not opposed to SAFs. I think they're okay.
I like seeing creativity. I just want to keep people complying with certain things and not expose them to anti-fraud issues.
Further questions. Earlier today, I thought I heard somebody say that they were doing a token offering using Reg D and taking accredited investors from the U.S., but taking foreign investors and not worrying about whether those investors were
Well, they were doing it in combination with the S1, so they had two different offering types they were trying to run in parallel. And I don't know, is there any integration issues when you do?
So you could do what's called a concurrent Reg D and a concurrent Reg S. And the preliminary notes to Regulation S clearly say that they won't get integrated. But almost, I would say 80% of the folks that are doing the Reg D, Reg S concurrently, the US versus offshore, they haven't done it correctly. Like, if you do concurrent offerings, you're supposed to actually treat them as separate offerings. Otherwise, you're just having one big, massive offering. So the big mistake most people have been doing is they've been giving lip service to the fact that, oh, we're doing a Reg D, and we're simultaneously doing a Reg S. But in fact, the way they've conducted their offering, they violated both Reg D and Reg S, and they have zero exemptions whatsoever. That's the issue. But if you properly did it, yes, you're Reg D, verify your accredited investors, Reg S, don't need to be accredited.
So so in that end, we got to close out. Anybody wants to have any questions, you got to charge them by hours. This was free.
That's fine.
And he's one of the best lawyers. These are the best lawyers over there.